All right, let's dive deep into the Q1 2025 earnings call from Applied Optoelectronics, AOI. We've got the materials, and our job really is to cut through the noise, get past the jargon, and give you the clearest picture of how they did, what's driving things, and what they see coming down the pike.
Exactly. It's about pulling out those key insights. Understanding the story behind the numbers and looking at how their big strategic moves are lining up with what's happening in the market.
Yeah, and there was definitely a lot to unpack on this call, especially around manufacturing.
For sure.
So let's start high level. The results snapshot for Q1 2025. How did the financials look?
Okay, so for Q1, revenue landed at $99.9 million. That was pretty much right in line with their guidance, which was $94 million to $104 million.
Okay.
Non-GAAP gross margin came in at 30.7%. It was actually a bit better than they guided. They expected 29% to 30.5%.
Oh, interesting. Beat on margin.
Yeah, slightly. And the non-GAAP loss per share was 2 cents, again, right within the guidance range, which was a loss of 7 cents up to break even.
So revenue on target, margin a little better, loss within range. Sounds pretty stable on the surface for the quarter itself.
It does, but the year-over-year numbers tell a much bigger story.
Right, I saw that. Talk about the comparison to last year.
Well, compared to Q1 2024, revenue more than doubled.
Double. Wow.
Yeah, and that gross margin, it jumped by over 1,000 basis points year over year. Huge improvement.
That's significant.
And they also made a point of mentioning they generated positive non-GAAP EBITDA in Q1. That's a good indicator for operational cash flow, especially with all the spending they're doing.
Doubled revenue, massive margin expansion year over year. Okay, that really paints a picture of a company in transition. So what's the outlook they gave for Q2?
For the second quarter, they're forecasting revenue between $100 million and $110 million.
Okay, slight potential uptick sequentially.
Right. Non-GAAP gross margin, they expect it between 29.5% and 31%. So maybe holding steady or slightly down from Q1's beat.
Yep.
And the non-GAAP loss per share projected between $0.03 and $0.09. So still looking at a small loss for Q2.
Okay, so that guidance gives us a sense of the near term. Let's break down where that Q1 revenue actually came from. The segment mix was pretty dramatic.
It really was. Heavily weighted towards CATV cable television. That was 65% of the Q1 revenue.
65%.
Yeah. Data center was 32%, and then everything else, fiber to the home, telecom, was just the remaining 3%.
Let's focus on that CATV piece then. 65% is massive, and it sounds like that was the engine behind that incredible year-over-year growth you mentioned.
Absolutely. CATV had a record quarter, pulled in $64.5 million.
Wow.
Like I said, up more than 6 times compared to Q1 last year. And even sequentially up 24% from Q4.
6 times year-over-year growth.
Right.
Just in CATV. What's fueling that?
It's primarily these ongoing, very large shipments of their 1.8 gigahertz amplifiers.
Okay.
These are going to a major North American MSO, a big cable operator who's doing major network upgrades. It's all tied into that push for more bandwidth, specifically the DOCSIS 4.0 rollouts.
Ah, right. Faster internet over existing cable lines. So this isn't just some fluke. It's tied to a big infrastructure cycle.
Exactly. A very specific customer upgrade cycle.
So after that record quarter in Q1, what are they expecting for CATV in Q2? Can they keep that momentum?
They're actually guiding for a modest pullback sequentially in Q2.
Oh, okay. Why is that?
The reason they gave was about production. They need to retool some lines because they're expanding their offering. They're adding Motorola-style amplifiers to the mix alongside the Game Maker style they've been shipping.
Ah, broadening the product line.
Right, which expands their market. But it means balancing production of both types in Q2 and specifically building up stock of both here in the U.S. by late June.
Okay, so a bit of a strategic pause to gear up for a wider market. You mentioned U.S. stock. They talked about an intentional inventory build related to tariffs. Should we be worried about that?
Management seemed pretty calm about it. They said they have really clear visibility. It's tied to a specific large volume order. They get regular updates from the customer, from the channel partner.
So they know where it's going.
Yeah, they feel confident it'll be used up by Q3, and they actually framed it as a benefit, having that stock stateside, given the tariff situation and, supply chain security concerns.
Right. That makes sense.
Yeah.
Okay, good visibility there. Let's switch over to the data center side then. CATV was booming, but data center was down sequentially.
That's right. Data center revenue was $32 million in Q1. Now, that was up 11% year over year, which is good.
Okay.
But it was down 28% compared to Q4. Pretty noticeable drop.
Yeah. What caused that?
They pointed to 2 main things. typical seasonality you sometimes see in the hyperscale world, and maybe more significantly, inventory digestion by one large hyperscale customer.
So a big client just had too much stock on hand from previous orders.
Essentially, yeah.
Yeah.
Working through what they already bought.
Anything else impacting data centers in Q1?
Yes, actually. An interesting wrinkle. They saw this unexpected surge in demand for some older legacy 100G products.
Really? Legacy stuff?
Yeah. They think it might also be tied to tariff worries, customers pulling orders forward. But here's the catch. They ran into supply constraints on a specific component needed for those 100G parts.
Oh, so they couldn't even fully meet that unexpected demand.
Exactly. It limited how much they could ship in Q1.
Yeah.
They expect that supply issue to get better, though. They think they can recover some of that missed demand in Q2 and get fully caught up by Q3.
Man, tariffs really seem to be rippling through everything: inventory strategy, demand patterns.
It seems like it.
Okay, what about the really high-speed stuff? 800G, the AI backbone optics. Where are they with customer qualifications? That's critical, right?
Absolutely critical.
Yeah.
And they reported progress there. Multiple customer qualifications are underway for 800G. They didn't name names, but said it's more than 5, but less than 10 distinct qualifications running right now.
Okay, multiple irons in the fire.
Right. And interestingly, they mentioned some of these customers are actually asking them to speed things up, especially as AOI gets its US-based production ready.
That's a good sign. Were they actually shipping any 800G in volume in Q1? Or just samples?
They did book some initial 800G revenue in Q1.
Mm-hmm.
It wasn't for, mass deployment yet. It was tied specifically to those customer qualification activities.
Ah, so paying for the qualification unit.
Right. They estimated maybe 5,000 to 10,000 pieces shipped for that purpose. It's small, but getting revenue for quali units is a key milestone.
Definitely. And then there was the big Amazon deal announced back in March. Any updates on that from the call?
Yeah, they touched on it. Said they're actively working to get the necessary products delivered for qualification with Amazon. You can tell the focus there is intense, showing they can deliver and scale up to hit that potential $400 million plus annual revenue target that's tied to the warrants in the deal.
Still early stages, sounds like, but obviously a huge priority.
Huge.
They also mentioned getting 3 new design wins during the quarter, but with an existing hyperscale customer. Were those for 800G?
Good question. No, they made a point to clarify that. Those 3 new design wins were not for 800G.
Okay, important distinction.
Yeah, 800G qualifications and potential wins are a separate track, still ongoing.
Got it. So beyond Amazon and these existing customer wins, what about bringing new hyperscalers on board?
They definitely highlighted ongoing talks and significant opportunities with other potential hyperscale clients. And a big part of their pitch there is the U.S. manufacturing angle.
Back to that again.
Yes, because it's becoming crucial, partially due to tariffs, but really, really importantly, because of PAA compliance, the Buy American Act stuff.
Right.
They argued that very few suppliers can actually meet PAA rules by making these high-end optics in places like Taiwan or like AOI in Houston. They see this as a major strategic advantage, especially for AI transceivers and potentially any government-linked business.
So that PAA compliance could be a real door opener, a differentiator?
Potentially a huge one. It could be a choke point for competitors who rely more heavily on China. That makes sense. Okay, that U.S. production angle seems absolutely key for their high-speed ambitions. Let's pivot back to the financials slightly. Gross margin, 30.7% in Q1. What drove that?
Primarily 2 things. That favorable product mix, thanks largely to the strong high-margin CATV business we talked about.
Right.
And just ongoing improvements in manufacturing efficiency. They also reiterated their longer-term target, getting back to around 40% non-GAAP gross margin. They seem to think it's achievable as production scales up, especially with higher margin products like 800G eventually ramping.
Makes sense. What about operating expenses, OpEx?
Non-GAAP OpEx was $35.5 million in Q1. That's about 36% of revenue. It was up year over year.
Why the increase?
Mainly higher R&D developing those new 800G and 1.6T products cost money, and also higher G&A costs, just reflecting the overall increase in business activity.
And for Q2?
They guided OpEx a bit higher, in the range of $36 million to $40 million.
Okay. Now, even with that operating loss in Q1, they sounded pretty confident about the full year, didn't they?
They did. They explicitly said they expect positive non-GAAP net income for the full year 2025.
A whole year.
Okay. And that positive non-GAAP EBITDA in Q1, they pointed to that as evidence that operations are generating cash to help fund their pretty significant CapEx needs.
Right. Let's talk about that CapEx, the balance sheet and investment plans. Cash went down a bit in Q1.
Correct. They end in Q1 with $66.8 million in cash. That was down from about $79.1 million at the end of Q4.
And inventory went up.
Yes, inventory increased by about $12.3 million, hitting $88.1 million. A lot of that was raw materials for both CATV and data center, including that intentional COTV build we discussed.
But they also raised a bunch of cash recently, right, through that ATM offer?
Exactly. They brought in $98 million net of fees using an at-the-market offering, selling stock gradually into the market to fund these big plans.
And those plans involve some serious investment in manufacturing.
Very serious. Capital expenditures were $30.5 million in Q1 alone, heavily focused on expanding capacity for 400G and 800G transceivers.
And the full year plan?
It's massive. They reiterated their expectation for $120 million to $150 million in CapEx for all of 2025, mostly for boosting production volumes of 400G, 800G, and eventually 1.6T.
Wow, that's a huge bet. Where is all this expansion happening physically?
It's focused on their U.S. and Taiwan sites. They have the HQ and a plant in Sugar Land, Texas, one in Ningbo, China, and one in Taipei, Taiwan.
Okay.
The big money is going into retrofitting the Sugar Land facility. They're putting in automated production equipment specifically for 800G and 1.6T. That gear starts arriving around June, and they hope to be producing and shipping from there later this summer, probably Q3.
Okay, U.S. automation coming online soon.
And in Taiwan, they leased a whole new building late last year, started fitting it out in Q1. That's the increased production of 100G, 400G, 800G data center stuff, plus some CATV products as well.
They gave a pretty wild target for the overall capacity increase from this, didn't they?
They really did. Stated they expect to increase production capacity across their U.S. and Taiwan sites by 8.5 times by the end of this year.
8.5 times. That's ambitious.
Hugely ambitious. A massive ramp up in potential output.
So what's the core strategy behind this enormous push, especially putting so much focus and money into the U.S. facility?
It seems multifaceted. First, they kept emphasizing that customers want reliable domestic manufacturing. Supply chain security is a huge deal now, especially for these critical AI components.
That makes sense.
Second, their core laser technology, already made in the U.S., so it leverages an existing strength.
Okay.
Third, they pointed out their 800G and 1.6T designs already have less than 10% China content, and they see a path to get that near zero. That makes U.S. or Taiwan assembly much more practical and attractive. They're even talking to suppliers about them moving production onshore.
Reducing reliance on China across the board.
Exactly. And fourth, back to PAA compliance. Making it in Texas or Taiwan is key to meeting those Buy American rules, which, again, they see as a major advantage for certain hyperscale and potential government business.
So it's security, leveraging existing tech, de-risking from China, and unlocking PAA opportunities. Is there also a margin angle to making things in Texas? Do they think they can make more money per unit there?
They suggested yes. Management hinted that customers might be willing to pay a premium, maybe 10-15% more, for U.S.-made product because of all these factors.
Interesting.
To combine that potential premium with the cost benefits of the new automation they're installing in Sugar Land. And yeah, they see potential for higher profitability per unit from the Texas factory.
Okay, so pulling this all together, you've got the CATV business acting as a strong foundation right now, bringing in cash and boosting margins.
Right, providing momentum.
And at the same time, they're taking that momentum, plus the cash from the ATM, and just pouring it into this massive capacity build-out in the U.S. and Taiwan.
Aggressively positioning for the AI data center boom.
Specifically targeting 800G and higher speeds, banking on those hyperscale qualifications coming through, and leveraging that strategic U.S.-Taiwan footprint.
That sums it up pretty well.
So if they're expanding capacity so aggressively and have these customer qualifications ongoing, what does that imply about their market share goals? Especially with the big hyperscalers.
They're definitely aiming high. Management sounded very confident. One exec even threw out a personal belief they could potentially capture 40% or more share with key customers like Amazon once everything is ramped up and qualified.
40%, that's bold.
Very bold. But their confidence seems tied directly to that U.S.-Taiwan production advantage and the PAA compliance angle for certain deals. They think they have a unique edge.
Is there a risk here with timing? Are they ramping 800G just as the market might be shifting focus to 1.6T? Could they miss the main wave?
They address that. Their take is that the 800G market itself is still, quote, enormous, and really just starting its big growth curve now. While 1.6T is definitely emerging, they see it currently aimed more at specific players like NVIDIA or Google. maybe not the broader hyperscale base they're initially targeting for this big ramp. They feel their 800G capacity coming online in the second half of this year lines up perfectly with major market growth for that speed.
So they think 800G has plenty of runway and 1.6T is the next step after that.
Pretty much. They're working on 1.6T, but the big bet right now is nailing the 800G ramp.
Okay, that gives us a really thorough picture. The Q1 numbers, the segment drivers, the financials, and this incredibly ambitious manufacturing strategy. Let's shift gears now, just for a moment, into our This Is Not Financial Advice segment. We're going to explore a potential scenario based only on what we've just laid out from the call.
Right. Emphasis on not financial advice. This is purely a thought experiment, an outrageous but plausible idea spun directly from the company's commentary and plans. Strictly hypothetical.
Exactly. So let's put on that speculative hat. We heard about the plan, 8.5x capacity increase in the U.S.-Taiwan by year-end, potentially the largest domestic 800G capacity.
Backed by $120 and $150 million in CapEx this year, significantly funded by that $98 million ATM raise.
Plus, the Amazon deal is a potential $400 million plus carrot, and this PAA compliance edge for U.S.-made optics.
Okay, so putting those ingredients together, you could theoretically build a super aggressive, highly speculative trade.
Go on.
The bet would be this. AOI executes this massive capacity expansion flawlessly through the next 2 quarters. No delays, no hiccups.
Perfect execution.
Then they nail the customer qualifications for their US and Taiwan-made 800G products, maybe faster than expected.
Swift quills.
And then, because they're strategically located, PAA compliance supply hits the market exactly when hyperscalers are desperate for secure domestic sources. They capture market share way faster than anyone anticipates in the second half of 2025.
So the core idea is betting the market underestimates how quickly a perfectly positioned player, right place, right time, right compliance funded up, could grab share in this critical AI market, assuming zero execution stumbles.
Precisely. It's a bet on flawless execution, hitting perfect market timing, with PAA acting as a turbo boost. It ignores all the usual potential ramp challenges, delays, qualification hurdles.
Yeah, tons of things would need to go exactly right. High risk.
Absolutely. But you can see how someone might construct that narrative based purely on the optimistic picture painted in the call.
An interesting, if extremely speculative scenario to mull over.
Definitely. And again, just for discussion purposes.
Okay, let's wrap up this deep dive. Key takeaways from AOI's Q1 call seem pretty clear. First, CATV is the powerhouse right now, providing strong revenue and cash flow.
Giving them the foundation.
Second, they are making absolutely enormous bets on expanding manufacturing, especially in the US and Taiwan.
The 8.5x capacity goal by year end is the headline there.
And third, the whole strategy is geared towards capturing a significant piece of the high-speed optics market, particularly 800G, starting in the second half of this year, banking on customer qualifications and that strategic U.S. production advantage.
Management certainly projecting a lot of confidence in the long-term demand from both cable upgrades and AI data centers.
So with that incredibly ambitious capacity plan underway, and hyperscalers reportedly emphasizing U.S. production, here's a final thought for you, the listener, to chew on. Is the market fully pricing in the possibility that a company executing this kind of strategic domestic ramp-up could gain share in cutting-edge optics much faster than typical industry cycles might suggest? If they nail the execution, what could that look like?
And maybe what specific milestones or metrics in their Q2 or Q3 reports would you watch most closely to see if that aggressive scenario is actually starting to play out or if the challenges are proving tougher than hoped?
Definitely something to keep an eye on as 2025 progresses.